So the next thing we want to talk about are commercial mortgages, commercial properties, and how are those going to work. Now, the nice part about commercial properties, and we just talked about residential properties, is we have the opportunity with these these commercial properties to do things in a totally different way. So with commercial properties, on average, there's generally going to be 5 units or more, 5 units or more, and, or should I say, or anything with a business in it. Anything with a business in it. So you could have a 1 unit building, let's just say a Walgreens or a CVS building. It's only got one tenant in it, Walgreens or CVS, but that would be considered commercial because there's a business in it. If you have a 2 unit building, obviously it doesn't get to the 5 units, but say let's in the main level you have a beauty salon and upstairs you have a 1 bedroom apartment. That would technically be a commercial mortgage. Now it would be mixed use when it comes to insurance purposes, but it would be a commercial mortgage because there's a business in that property. Now what do we see with commercial properties? And I'm going to give you some average. Generally, you're going to see 65 to 70% LTV, which once again is loan to value. For those of you guys that are just starting this out, you should be starting to understand what LTV stands for, what FMV stands for, fair market value, what ARV stands for, after repair value. You should start to be understanding some of these acronyms. Generally, on a commercial mortgage, your amortization time frame is going to be more along the lines of a 20-year amortization. These are just common things when it comes to commercial mortgages. Now, I'm not saying you can't find a commercial lender out there that will do 75% loan to value, do a 25% or 25-year amortization. They're out there, but the majority of them are going to fall in this region right here. So when we're looking at commercial properties, this is the biggest win for us. If I buy a 4-unit building, just like we said in the last video, they're going to check my credit, they're going to look at my debt to income ratio. As soon as I get to 6, 7, 8, 10 units of commercial mortgages, they're not checking my personal credit anymore. Not checking personal credit because what are they doing? They are looking at this property. They are looking at this property in that what? They are able to just see the income of the property, so the loan is based on the property income, not based on your personal credit anymore. So the loan is based on the property income, not your income. Now I know some of you guys are going, well, why do they do this? Well, the reason they're doing it is, first of all, they're not giving you quite as much of a loan to value scenario. They're not giving you quite as big of a loan to value. They're not at that 80, 85% or whatever. They're not doing a 30-year term. They're usually doing a 20-year amortization term. So they're taking a little less risk on this. But what they're looking at is, what if you don't pay them? What does the bank do if you don't pay them? They're going to foreclose on you and take the property back. So if they take the property back, they're only taking it back at 65 to 70% of the actual value. And they already know what the income is. And if that income is adequate, they're going to loan you based on that. This comes down to some very specific things that we need to think about. Is a lot of times people say, well, Pip, what if I get a corporation? Should I do things in an LLC? We'll talk some more about that stuff in future videos. The one thing I will tell you when it comes to legal stuff, I'm not a lawyer, so I always say check with your lawyer. Make sure that you're running it by the proper people that do understand that, your accountants as well. But I do know for a fact is when you borrow money in an LLC, most residential mortgage brokers cannot lend to an LLC. You immediately go into commercial lending when you're loaning money into an LLC. And the other thing that I can probably promise you is that if you're borrowing money in an LLC that's less than 2 or 3 years old, and maybe even older depending on the lending institution, they're going to require you to do a personal guarantee anyway. And so as far as borrowing money, the LLC is not going to give you a ton of benefits. It will give you a ton of benefits when it comes to taxes. It will give you even bigger benefits when it comes to lawsuits. And so there's reasons we do things, but the key is with a commercial property, here's the other thing. If you're going to borrow 65 to 70%, they don't care where the other 30 to 35% comes from. So you can use a joint venture partner to bring the 30 to 35%, and then you can get into commercial properties with none of your own money, and technically none of your own credit because they're not checking it. These are some very good tips and tricks that most people don't know when it comes to doing property because they think, oh, I've got to start small. I'm not saying we're going to go big on the first deal, but we can get into a 6, 10, 20 unit building and literally have less risk than if we have a single family house. In fact, I would like to share this with you, even though this video will probably run long. The riskiest type of real estate investment is a single family rental. Why? Because if you have a vacancy, on that property, you have 100% vacancy. If you got a 10-unit building and you got a vacancy, only 10% of your property is vacant. So there is some benefits to go bigger before we start, or as we start this business, rather than starting really, really small. So I look forward to seeing you guys on the path.